Welcome back, everybody, to the Strategic Small Business virtual event. I'm excited for our next guest, Solomon Ali. I'm going to allow him to introduce himself because this man has some incredible knowledge to share with us, and I don't want to do him any disservice. So, Solomon, please tell us a little bit about yourself.
Well, my name is Solomon Ali. I'm CEO of several companies. We ran the fifth largest minority energy company in the United States. We currently have the smart home technology that we hold out intellectual property, which we license out to companies like Ring, CPI, which everyone knows that Ring is owned by Amazon and stuff like that. So we're really excited about those things. I've been on the board of directors of three publicly traded companies as an officer and a director responsible for raising capital. And so we've been able to do a really great job in helping companies to scale and to grow. With 13,000 publicly traded companies, only 13 have been African American managed and controlled. To sit on three publicly traded companies, it was kind of a great milestone to achieve, to be able to do that and to raise the capital and help them to grow and scale to become companies out there that would be the fifth largest minority company in the United States, or to control the smart home technology piece. So it's
Well, and isn't that always the challenge? Capital raising right off the bat. So my question, I think my first question that I'd like to ask you is how, as a small business owner, can our audience raise funds? If you were to speak to me as a small business owner, what do I need to know about raising funds? Let's start there.
Well, the exciting thing about raising funds is this. Everyone gets really excited about their product or their service, right? But they forget, they either take their money out of the equity in their homes, they borrow from family or friends, or they grab it from credit cards. And they always think that the business idea and the concept is going to work. And they never think about, wait a minute, let me surround myself with really talented people that know what they're doing so that I can put a good business plan together and go access more funds before I need it. And that's what I would suggest to anyone. Before you start that long journey of hills and valleys, is that you put a really good team around you and you begin to raise more capital. Take the little capital that you have already started with and use it to actually raise more capital, whether that be debt capital or equity capital.
And what's the difference between the two?
Well, debt capital is what we would traditionally call bank loans, all right? A bank loan is basically going to look something like this. They're going to look at 3 years of historical numbers. And the exciting thing about it, if you got 3 years of historical numbers and you can show that you can support 1.25, they're probably like, okay, that's great. You can cash flow. So then the next thing that they're going to look at, and it's going to excite them, is, oh, what kind of collateral and assets do you have? So that's what basically the banks are going to look at. And they're not going to go dollar for dollar, people. They're going to go a percentage. And that's normally somewhere between 25 and 40%, okay, of what the asset value actually is. Equity is ownership. You're giving up fractional ownership within your company. It's a more expensive way to actually go. It is an exciting way because other people are sharing into your vision, okay? And they're also sharing the risk and the rewards with you. So if the company does extremely well, equity owners actually benefit as well. But they also run the risk of losing money. So you as a CEO or as the founder, you have to be really sure when you're ready to bring in the equity money, because sometimes you want to keep a lot of that equity for yourself. But the other thing is you got to be mindful that you're responsible for other people. And we all know he who's at the top always get blamed no matter what.
Right. So that kind of equity raise, that's typically what we're seeing in a show like Shark Tank, for example, where you have a business owner or somebody with a widget or an idea or a product, and they're coming to the sharks and they're saying, I'm going to give you X number percentage of my company for X number of dollars, and that becomes kind of that valuation of the company. Is that correct?
Well, that's a great way to do and explain it. Yes, and they do a combination of equity and debt and things of that nature, and so that's exciting. When we get you mentioned the word valuation. Valuation of the company is basically going to be determined by your net profit. At the end of the day, let's say your company is making netting $1 million. Your industry might have a multiple of three. Okay. So that company is actually worth roughly $3 million. Now, there's always going to be a discounted rate in there because if you're not the number one, two, or three company, I wouldn't pay you $3 million for your company because you don't have enough in the market share. So that means you're still a private company, and a private company is not valued the same way as, let's say, a public company, which creates an exit strategy for everyone. And the exciting thing about having an exit strategy is your shareholders or your fractional owners can get out at any given time that they wish, whether it's to pay credit card debt off, whether it's to pay college tuition, pay medical bills, or things of that nature. They own the shares and they're able to liquidate those positions when they choose to. And of course, like anything else, the stock price is really based on your earnings per share. So you have to look at that. But if we back up and go to a private company again, and we look at how a private company is valuated, you take your net profit. If your industry is 3, you give it a multiple of 3. Now, it depends on the industry because every industry is different. I like to break it down this way. If I'm looking at a company, it's going to come down to one simple thing. What is the buyer willing to pay for it? Because he has to believe or she has to believe that there's some value there. Okay. And what is the seller willing to sell it for? So those two parties have to be able to come to terms. We can do appraisals, evaluations, which are basically opinions, okay, because sometimes it's really difficult to get a valuation on a company. And what we're looking at are historical numbers. So we take the historical numbers. Historical numbers are normally going back at least 3 years. And we're looking for the trends, the ups and downs and things of that nature. And then we're looking for, of course, the supporting information. What type of vendors are they using? What are their payouts? What are their actual expenses and obligations so that we can get a good feel for that? And then we can forecast going forward. Once we can understand and put a model together, we can forecast, project some people going forward, and then we can back into that. But again, if it's worth $3 million, a guy like myself probably going to pay you about $1.5 million, $1.8 million on something that's worth $3 million, especially if you're not the number 1, 2, or 3 company within your industry. And that's very important because that determines how much market share you have. Okay.
And you've mentioned it a few times now, the multiples. So if you're doing $1 million revenue, you'd said that there was a 3-time multiple on that, depending on your industry. How could I find out what that multiple is? Is there a standard table, or is that just something that you have to get good at from a venture capitalist standpoint, that somebody knows what those industry multiples are?
Well, the people already know, people in the industry, but you as a new entrepreneur, you can look at your SID code for your industry, and then that will give you a good determination. Then you can look at the comparisons. The first thing you should always know is what's going on within your industry. You need to understand your industry. Who is the number 1, 2, and 3? You should know the top 5 companies. If you notice, I always focus on number 1, 2, and 3, but you should actually know the top 5 companies in your industry. And you should have a good understanding what makes them successful, what works, and why does it work, so that you can understand how to evaluate their company and why people are evaluating their company a certain way, so that you can determine how to evaluate your company. Because everyone's going to tell you what your company's worth very quickly. When you go to the bank, they're going to tell you how much you can borrow based on your balance sheets, based on your profit and loss. Okay. You come to a private equity or a VC, they're going to tell you the same thing, unless you got something that's very, very unique, and then they can see an opportunity there. Okay. you're going to have to be prepared to give up controlling interest and a lot of your company on an idea, okay, or in other words, on a dream. So if you have a company that's already existing, driving revenue, please understand you need to learn your industry. So you will go and look at your industry code.
And when you're talking top five within my industry, then you are referencing the market share, right? Who's sitting on top? Who's generating the most publicly traded?
Well, not even publicly traded, even private companies. What I'm looking at and what you would want to be looking at is who's generating the most in sales. Okay, who has the largest market share? So if it's let's say a $80 billion market, and someone out there has 10% of the market, that's a pretty large market. And that means they're doing roughly what, $8 billion in sales. So why are they able to get 10% of the market, and how did they achieve 10% of the market? So what are they doing? Who's the number two company? And you go right on down the list. And so you try to make a comparison of what is the number one company doing versus the number five company doing to make them successful and to create and to drive value. Okay. Because that's what's very important. Listen, how do we drive value within our company? Basically, we want to increase our costs and we want to make as much money as we can. And we want to be able to provide an excellent service, or we want to be able to provide an excellent product at a really good cost, right?
Mm-hmm.
So ideally, I want to sell something for maybe $100. However, my cost on that, after operations and everything, I want it to be around $35. So now I have an excellent margin there. Okay. So with that margin, okay, what makes me different? Now, one of my competitors, they might only have a 25% margin. Another competitor might have a 10% margin. And I need to try to figure out and understand what's driving their margins so I can improve my business, especially if I'm looking to sell it in the future. You know, normally when we come in as entrepreneurs, we're looking 6-7 years down the road. And looking that far down the road, what we're trying to figure out is how to grow our business. That's what we're all excited about, is growing our business, getting in there, doing it, and growing the business and making a profit, right? Well, sometimes we don't realize, oh, we're going to hit some valleys. It's not all the hilltops. We're going to hit some valleys. So when we hit the valleys and we lose money, okay, and our books show a negative number, it kind of sets us back. And it's like having to start all over again, because now if you go to the bank's like, well, you know, why don't you go and do it again and come back and we'll see how it looks. Okay. You know, in the old days, when I first started, the banks would just kind of average it out. They really don't do that anymore. They would just take your last 3 years and average it out. Well, they really don't do that, and they don't like doing that. So the banks have gotten to the point to where they sit back and say, yes, you got a debt service of 1.25. If you have $1 million in assets, they may come back and say, we'll loan you $250,000. And you may respond, well, I'm giving you $1 million in assets. And they say, well, we understand. And the reason they do that is because they're taking the risk. And they take a huge risk for your dream, okay? But if they had to sell your company very quickly, they want to turn around and be able to take the assets, sell it for $500,000, and leave enough upside for the next person to come in and buy it and feel as though they got some value for it, okay? And so that's what they're looking at. And you as an entrepreneur, a new business owner, or even an old business owner, you got to be able to understand that. When you come looking for money, you got to be willing to give up some control. When you come looking for money, you have to understand it's going to cost you something. And what are the metrics that we're actually looking for to make that decision? If you are looking for fractional ownership and looking to make an equity, I may sit back and think my company's worth $20 million. But at the end of the day, you may sit back and, like you mentioned earlier on Shark Tank, you may sit back and say, well, hey, yeah, you think it's worth 20 million, but your sales don't support that. And when we look at it, you might have a $50 million company, but you're only netting $10,000. Well, the reality is, yeah, you're turning a lot of money, but really your company's only worth about $30,000. Okay. And a lot of people will find that very hard to stomach and to believe, because what they get caught on is what that gross sales number that they're turning, and not on the net profit. Okay. What that company is generating. I had an experience years ago. And in fact, it was with one of the energy companies that we acquire, because we do a lot of roll ups, where they were doing millions and millions in sales, and their net profit was about $40,000 a year. And I was like, well, okay, we need to modify this. And you go in and you want to cut costs right away. Okay. You want to increase the customer base and things of that nature to increase the value of the company. So we wanted to do the things that made perfect business sense. Okay. But they didn't want to have any parts of that, because they thought, wow, we got this $1 million company. It's like, no, you don't, guys. It's not $1 million company. You do $1 million in sales or so, and that's phenomenal. However, making 20 or 30,000 at the end of the year, and that was a gross number. Okay,
Yeah.
so it wasn't even after taxes. Um, we would do better shutting you down than proceeding with that business model.
So I
So,
think it's that old adage, you can't manage what you can't measure. So before you start coming and asking for money, whether it's bank or private capital, you really need to know your numbers. Is that correct?
oh, absolutely. I'm glad you said that, because that's something that we used to say all the time. Every CEO should know its numbers. You must know your numbers. Your management team needs to know the numbers. The key performance indicators. Everyone needs to know the numbers all the way through, because that's the only way you can really drive and run a company, is by understanding what the numbers are. How do you get to profitability? And where do you cut costs, and how do you drive costs? Okay.
And KPI, the key performance indicators, as you had mentioned, that's a real interesting thing, because um, they could be anything. So anybody could report any statistic. As you said, some people were focusing on their um, gross sales, or they were focusing on their net profit or gross sales, or gross profit, net sale, like all, we have so many different terminologies, and right. And if somebody's looking at this number over here and they're not, and really what you care about is over here, when you're coming in yourself, what are some of those KPIs, the key performance indicators, that are key to you? What do you look for?
We help them to put in systems. Okay. And it'll be hard for me, because it'll take all your time, because we can sit there and talk about this all day. But we come in and we try to help them to put in key systems so that they can manage. So let's deal with marketing. If they're doing marketing, then we're going to sit there and say, okay, how do we measure marketing? The first thing we're going to do is like what most efficiency experts would do. Let's see what you've been doing and how you have been measuring this. Okay. And most of the time what you're going to find out is, of course, that they haven't been, because they didn't even know to measure it. And so what we will do is we will say, okay, how many sales you have coming in? Who are your sales people? Who are your marketing people? What is the existing structure that you have? Okay. What is the cost? Okay. And then we break that cost down. Okay. How much is it to actually produce a customer? What does that look like? Okay. How many employees, or how many employees does it take to generate that particular customer, and who's going to be responsible for what? So if you have a marketing manager, okay, what is his duties and responsibilities over the salespeople? If you have 5 or 6 salespeople, are they in regions? So how are we going to break that down? What are the accountability per region are we looking for? Okay, because every region may be different. Okay, so that's what we're going to sit in and try to put in place.
Excellent. And you had mentioned it off at the beginning, the companies that you'd help bring public. How do I know, or what are some of those indicators that I should start looking at making my company public?
Well, profit, profit, profit. Okay. That's the first thing. The last few companies I didn't take public. They hired me to come in to raise some capital and sit on their board and to provide strategic advice. And in doing that, what we try to do for companies and what you're asking me is what we're going to say is let's look at your profitability because being public costs money. Okay. However, we talked about earlier, a multiple for a private company may be 3 times. Okay. And based on the industry, that changes. Well, when you go public, that same company doing the same revenue, here's the exciting thing, and it gets me so excited, is that multiple might be 10 times, 15 times, 20 times. Same company, same revenue, same management team. Nothing's changed other than your private versus being public. So the public company has a higher multiple than a private company. And so we ask owners real quickly, do you want to own 100% of $100, or would you rather own 50% of $1,000? And so most owners can make that assessment very quickly and very easy. So then the next thing we ask, where are you sitting in your industry? Because you need to really understand where your industry is. Where are you sitting? Is there opportunity for you to possibly do roll-ups? Okay. And that means let's go out and do acquisition after acquisition to help get you more revenue. And then we can actually take advantage of sizing and scaling and everything of that nature and getting rid of some of that duplication to create real value that will help to support and drive your price per earnings per share. So those are the things that we would focus on, and that's the things that we would try to get them to look at. So when you come and you say, oh yes, I would like to be public, and that's a great idea, but let's see if you got the basics and the fundamentals down, and if you actually can drive the company there, because it's a lot of work.
And we keep circling back to it then. It really becomes knowing the numbers, what you feel comfortable with, really what your risk aversion is, because if you're somebody who wants that control, becoming a public company may not be the way to go.
I would agree with you. Being public is a job, but running a business, whether it's public or private, is a job. And just because you are I'm going to use this analogy, a great salesman, don't mean you will be a great manager. Just because you are the inventor or creator or founder of something, don't mean you should be the one possibly running it. Maybe you step aside and let someone else run it who have a little bit more business experience and a little more business savvy, but you run the piece that you enjoy and that you love. Okay. And then that way you're able to maximize your business enterprise and you're able to get the most value out of your business enterprise. If you're the smartest one on the ship, your ship probably won't go too far. So the key is surround yourself with very talented people, people who have a lot of energy, people who are gifted in what they do, so that when they get on board and you've sold them on that dream, they can help you to drive that ship to where you want it to go.
And what advice would you have for anybody who literally is starting out with a dream and a prayer? Under 10 employees, they've got the idea, maybe they've taken the time to patent that idea, or they have a trademark on it or a copyright of some sort, and they don't know what they don't know. So what are some of those pitfalls that we need to look out for as small business owners?
Well, it's what we started with. It's how I started. It's surround yourself and hire experts. You need to hire your patent attorney, keep him close, because you're going to have to continue to do what? Add more claims, add more claims. It's not that you get one patent and that's it. You got to keep building upon it because the industry is changing. So you have to know that, oh, wait a minute. Yes, I got awarded this patent, but there's 10 other people coming in and they're copying your patent and laying claims on it. So you got to understand that, again, we're going back to understanding and knowing your industry. So you got to have your attorneys ready to go to keep laying claims and layering them and things of that nature so that you stay a dominant force within the industry. You got to get a good tax attorney. Okay. You got to get a good accountant. Okay. I would rather use a good CPA than an accountant, but you have to have that. You have to have a good marketing person. You have to have a good finance person that understands how to raise capital, what capital is going to cost, and be honest with you. And some people say, oh, well, my CPA can help me with that. No, they can't. Two different mindsets. They think totally different. They see things totally different. A finance guy that understands the market, understands your industry, that understands how to go raise capital. He understands what the banks are looking for. He understands what investors are looking for. So in other words, you just need a Solomon Ali if you can sell him on the dream to help you out, okay? And it's not easy. And that's the other thing that you really have to understand. It's not easy selling someone on your dream and then going out selling the money on your dream. Because as the money have already earned it, they're looking at they have something to lose. You have everything to gain, but they are the only ones sitting at the table with something to lose. And you're asking them to bet on you, to bet on your dream, to bet on your vision. So that's the first thing, and the first real conversation you have to have with yourself is, what am I asking of the people who have the money?
And that actually is a good point, because you had said somebody needs a Solomon Ali. And as somebody who may need a Solomon Ali, you don't need everybody who needs a Solomon Ali. So what do you look for? When somebody comes to you and wants to work with you, what does that ideal client look like? Who is successful? What are you asking for up front so that they're prepared when they come to your door?
I'm looking for a good management team, and I think mostly anyone and everyone in our industry, that's one of the first things everyone's looking for, is a really good, solid management team. You could have a great management team, and you can have a CD product or service, and your company can do extremely well. You can have a super product. Okay, it could be a product, a service, right? But you have a CD management team, you're out of business. So I'm looking for a really great management team. Then I'm looking for some depth in the management. I don't want it to be dependent on one person, because if that person gets sick or something happens and things of that nature, then we're all out of business. Okay, the money looks at it this way. We just lost our money because John got sick. Okay, no one wants to be in that position. But if you got depth in the management team, I'm looking at that. I'm looking at what type of contracts you have. I'm going to go over your contracts. Who do you have your contracts with? Okay, who are your vendors? Okay, that help support you. Okay. I'm going to look at your employees. I'm going to comb through your business, and I'm going to basically look at everything I possibly can. And what I'm looking for is to see that, first and foremost, your management team has the capabilities to run the business, whether you're there or not, that you have enough depth in there in your company, whether you're there or not, for it to continue on. And then whether or not you have enough employees there, okay, that can actually do the job. Now, I say that right now, knowing that in the future, if you tell me you got 20 employees, I may be looking at you saying, well, John, hey, can we do 6 employees and go buy a few? Can I loan you some money to go buy a few robots to increase productivity and things of that nature? So I'm always going to be looking for ways to make your business more efficient, okay, to drive profits, okay? And that's a blessing for you in the sense that, of course, you making more money. It's a blessing for us because the valuation of the company continues to increase. See, the value of a company increases a lot faster than, let's say, what some people like real estate. I got a lot of friends that love real estate. Well, the value of a company can increase really fast, a lot faster than real estate. And a lot of times that's just based on increasing your number of sales, increasing your region of where you're doing business at, and just growing that market share and having a better bottom line. So that those things are normally, once you understand the numbers, those things are becoming that you can control. You begin to control those things and know how to control those things. You know what your cost is. You know what it's going to take to produce a customer. I was looking at a car the other day, um, and the guy was telling me, well, it's costs a really, really nice car. And he said it costs a lot. And I was like, okay. I said, but it's sitting on this lot. It's costing you a lot. So what is costing you to sit on the lot? How about, oh, it's been there a couple of months, I think it was. How about you give me a discount on what it been sitting there for, and I'll buy that car. And the guy didn't get it. And of course he didn't get it because he was just a salesperson. But I ended up speaking with his finance manager, and his finance manager got it right away because he knew that, wait, I bought that car with a line of credit. Mm-hmm. And every day it sits on that lot, it's costing him money. Okay. And he needed to turn it. Even if he broke even, he's able to help pay that line of credit back so he can continue to use it. And so it's understanding simple things like that within your own business.
Solomon, I got to say, it feels like you feel that knowing the numbers is critical.
Oh, absolutely.
I get the theme. I've been seeing that, and I appreciate that. So before we wrap up here, what is that one piece of advice, that one piece of information that you got when you started out that you think you would like to pass on to everybody that's watching right now?
I will say this, and I'm going to say it in a story. When I first started, I was about 21 years old. I had a little maintenance company. I had 71 employees, and I had to make payroll, and I had no money to make payroll. And we had done all of these apartments and things of that nature, and I was owed about $300,000 and some thousand. And I was looking for money. And I got on my knees and I prayed, and I read the Sunday paper, LA Times, and I found a company that said we buy accounts receivables. I didn't know what accounts receivables were. I had no clue at that time at 21 what accounts receivables were. And so I called the guy up and I told him, and I was brutally honest with him. Totally honest, told him I had no money to get there and everything of that nature. So please don't be wasting my time and things like that. And I had to get a friend to drive me down there. I get down there. I brought out all the paperwork he asked me for, a copy of the contract, copy of all the invoices that we had paid, where the supervisor and everybody signed off on and everything. And he gave me a check for $280,000. And I was like, wow, okay. And then he turned around, Alex, and he said, well, good luck, but do you need help cashing the check? Never thought about it, right? So you have to have people that understand more than you do, where you may not even be aware of the certain questions to ask. They already know. And so he said, well, go to my bank and you're going to have them wire the money right over to you. So there's no hold and things like that. And you can get your people paid. That was my first experience of understanding how a factoring company worked and understanding what accounts receivables were. That was burned into me. And after that, it was like, oh, okay, you better learn as much as you can, and you better surround yourself with really smart people. And that's one of the emphasis that I will share with everyone. Get really smart people. Do not think that you're wasting money by hiring professionals and circling them around you. Do not go start building widgets and think you're going to be successful with what little bit of money you have. Use that little bit of money to get professionals around you to raise more capital, and then go build your widgets.
That's perfect. So know your numbers. Make sure you surround yourself with people As smart or smarter than yourself?
Smarter than yourself.
Smarter than yourself. I like it. I like it. I'll give it.
Okay.
Shouldn't be too hard for me.
Okay. Me neither. I
Well,
do the same thing.
Solomon, it was an absolute joy talking to you, and I really do appreciate you taking the time to come to the summit and be on with us. If people wanted to reach you, what's the best way to get a hold of you?
Solomon RC Ali .info. Again, that's Solomon RC Ali .info.
All right, perfect. And we'll make sure that contact information is put on our resource pages. So again, on behalf of everybody who's attended the Strategic Small Business Education
Well,
Summit.
wait a minute. Let me correct that. My team is showing me something different. They're saying info@solomonrcali.info. Info@solomonrcali.info. 800-984-7563.
See, it's the benefit of surrounding yourself with smarter people, isn't it?
Oh, absolutely.
Well, we'll make sure that we get that information up on the resource page. So again, on behalf of everybody who's come to the Strategic Small Business Education virtual event, I want to thank you for giving your time, giving your knowledge, providing us with some really good insight into funding and what we need to know up front. So thank you for your time.